Now, the fact that we hit that 1181 twice, this was our double bottom, of course, and then as the market moved up, we realized that we would really determine whether or not we were going to continue in our bear market during this recent rally, because if it came to this long-standing resistance line and then bounced lower, it really told us we were still in this downward wave. However, that was not to be the case, and the market broke out solidly to the upside. Of course, our daily viewers know that we took our first stab at the market at around 1258. Got in and took a nice $62 out of the market. I think we got out at $13.25 and got back in at $13.33, and now the market is sitting at 83. So we only missed a couple of dollars on this rally. We did take it in right when it broke out. But here's the key. I had initially thought that what we'd probably see was some sort of an A, a B, and a C, because my belief was at that point that what we were experiencing really could be best characterized as a counter trend. And on a counter trend, as we talked about a little bit last week, we're looking for three waves, something like an A, a B, and a C. And then you would get a continuation to the downside, this whole downward trend, and this just being what we call a counter trend, meaning it's not a new trend but a counter trend. However, there's some real compelling technical evidence that's beginning to point out that we might in fact be at just the doorsteps of a super bull cycle to the upside. And let me show you what technical evidence I'm looking at, and then you can judge for yourself as to what kind of validity you see in these studies. So I draw your attention to this chart. It's a daily chart. And what we have put on this chart is a basic Andrews pitchfork. Basic Andrews pitchfork is derived from three data points. First data point is this record top, and that of course is going to form our midpoint or our handle. From there we go to the highs and then the lows, the high being 1800 right here, the low being 1500 right here. And what that allows us to do then is to put in the 0 and 100, meaning the outer prongs on this pitchfork. And so what we look for when we look at a pitchfork like this is, there's no doubt the market's in a downtrend, and so what we want to do is have these cascading channels down. And the way that we'll use it is, as this market breaks, for example, here, we take a look to see if it finds any kind of support at any of these different levels, this being the 76% level. You see it finds support, but then it finds resistance at the 50%. Market then comes to the bottom of this rung here. This is that 100%, and this is the first of the double bottoms. And you can see here's these two double bottoms. They don't look like they're identical in terms of the lows, but that's because of the cascading channel lines. As it comes up, though, just as we had that long-standing resistance line, you can see that it found resistance at that 23% level. Now, it comes down, and here we've got the market making a play and just at the zero mark or the outer prong on the Andrews pitchfork. Now, here's what I believe. My sense is that if in fact we get a break above this particular prong, the zero line, that is a really strong technical signal that we have in fact broken out of this long-standing bear market. And in fact, a move above this would signal the potential that we're not looking at a counter trend, but what we're actually looking at is a bullish trend. And traders, the ramifications are tremendous, because what that means is that market hits its bottom, and rather than having an ABC, we might get something like a 1, 2, 3, 4, and 5. In other words, we would go back into an impulse phase being defined as a bullish rally to the upside, waves 1, 3, and 5 being our uptrend, strong rally points or rally waves, and then our counter trend would be, of course, 2 and 4, just as we saw as this market moved up. That, to me, is a tremendous piece of information, because with that, we can ascertain really a new look in terms of the different models that we're currently working with. And here's what I mean. Traders, I've just put up a spot market gold chart, Japanese average format. And here what we're looking at is really the major count within the market. Because as you recall, when we looked at our basic Elliott wave, what we were looking at is this major move here, and we saw a series of 5 waves, 1, 2, 3, 4, 5. Then our corrective period, but we felt that this is probably, we're in a full-blown bear market. We're going to have this counter trend and go into an ABC corrective stage. The model that I'm currently looking at starts our super cycle at 2002. Gold is trading roughly at 300. 300, we get a move up to just over 1,000. From 1,000, we correct. This is our major 1. This is our major 2. From that major 2, we go into a dynamic major 3rd that takes us to a new record top at 1920. And at that point, we go into a corrective wave. That corrective wave, I believe, can be correctly titled now as M4 or a major 4. And what we witnessed there was basically an A, a B, and this long C down. We terminated with the C, went back into a impulse phase, and that impulse phase could be something like 1, 2, 3, 4, and 5, and it should actually culminate with at least a equal top or close to back to around 1800, if not a higher top. And with this in place, we can really start to do some effective modeling of where we think this market could go. Now realize what I'm referring to is a super cycle. This super cycle is going to take quite some time to unfold when you consider the fact that this major 3rd, for example, really spanned almost 3 years, 3.5 years. The corrections, this one was rather short, but if we look at this last correction, we had a correction that started really at the the end of 2011, right in here after we hit our top, and took us all the way to 2014. So these are long 2 to 3 year cycles. But with that in mind, here are some of the numbers we could look to see. And this, of course, is a very, very broad overview of the market, but bear with me because I believe that this could give us some real good information in terms of what we can look for over the next couple of years. And here's what I'm looking at. If we take a look at this first move, and this is the move from $300 up to $1,000, then the market corrects roughly 38%. We get a 38% retracement. This is the termination of that major 2nd. We go into a major 3rd. Now, on the major 3rd, in terms of predictive qualities, we're going to look at fib extensions. And so what we've done is we've done a fib extension from this move from 300 to 1,000, and we began right down here at the beginning of the next rally, and that's these numbers here. So you get 161% takes you to 1731, 176% extension takes you to 1847. So what it told us is that this wave 3 was just over 176% extension of our major 1st. Now, then we've created another extension, and on this extension, I'm simply looking at the move in 3. Typically, the move that we see in 3, when we look at our wave 5, this is going to be the major 5, and this is the extension. If wave 3 and wave 5 were equal, you're looking at $2,300 gold. I don't really see that as being the case. Now, a 76% extension of wave 3 would take us to 2068. And then if we look at just the straight extension, 161 from here, took you to about, what is that, 1890 right in here. And that's a 161% extension of wave 1 up to looking at wave 5. So what I'm trying to say is this. If in fact we are on the doorsteps of another leg in this market, what we could see over the next couple of years is something like this. Wave 1, major 2nd, major 3rd. We all lived through this major 4th. Thank God it's over. And then our major 5th over the next couple of years, taking us back up to new highs, because the conclusion of wave 5 should certainly be above wave 3. And my benchmark right now is just above 2,000, call it 2068.